Hello to everyone. This is the intrinsic value analysis for Alphabet. I hope you enjoy the presentation. I like to start with an overview of the key ratios of the company, starting with the PE ratio. As we can see, it has a PE ratio of 25, below than the sector and below than the average of the companies within my analysis portfolio. The price earnings growth ratio is around 1.1, which is good. Values around 1 are good, and it's below than the sector and below than the portfolio. The beta is around 1.1 also. Price to sales 6.8, below than the sector. It is, of course, a big company with a market cap around 1.5 trillion US dollars and 163,000 employees. Jumping here to the income statement, as we can see, the revenue has been growing since 2016. The net income also growing from 2016 with a net margin of 22%, higher than my portfolio and same value as the sector. In terms of revenue per employee is higher than the portfolio and the sector, the same for the net income per employee. Okay, the balance sheet, as we can see here, the debt level is low. It has a market cap to book value of 6.2. Values around 1 are good. 6.2 is not bad. In terms of debt to sales, it is 44% below than the sector. Debt to net income 1.7 below than the sector, and the cost of debt around 0.5. This is my estimation. I don't have the real value of the cost of debt, but this is my estimation. In terms of the cash flow, as we can see, the net operating cash flow has been growing since 2017. The same for the free cash flow and the free cash flow to equity. The margin, the free cash flow to sales, is around 23%, a little bit below than the sector, higher than my analysis portfolio. And in terms of debt to free cash flow, it's 1.8 below than the sector. So, intrinsic value. To estimate the intrinsic value, we need to start with some key data, let's say. First of all, we need to estimate the cost of equity in order to update the future earnings to its present value. I have estimated the cost of equity of 1.5% and a weighted average cost of capital of 8%. I also estimated a final PE ratio of 10, which has a price earnings growth ratio around 1. So basically, for this simulation, I have selected the low growth scenario with a cost of equity of 8.5, 8% for average cost of the capital, and a final PE ratio of 10.6. Looking here at the growth data, as we can see, the revenue has been growing at 18.2% over the last 6 years. The net income 26.2, free cash flow around 25. And based on these values, last 3 years, earlier 3 years, and so on, I estimate that revenue should grow at 17.3%, and same thing for net income, free cash flow, and so on. Based on this, it is possible to estimate the increase rate over the next 10 years. I have split it here within the next 3, 5, and 8 years, different values, as we can see, for sales revenue, net income, free cash flow, and so on. And this is based on the historic data and also on the selected scenario. So these are the values of growing for the next 10 years. In terms of margins, looking here at the net margin, I have estimated the minimum, the maximum, the average value, the median, and the business as usual over the last 6 years, and the estimated value for the next 10 years is 22.3%, with a standard deviation of 5.9%. The same thing for the other indicators. So, forecast. This is my forecast for the next 10 years to sales, net income, free cash flow, and earnings per share. This forecast is, of course, based on the selected scenario. To estimate the values for the next 10 years, I use a Monte Carlo statistics. Basically, it uses the average values and the standard deviation for each of the selected indicator, and it will generate 300 scenarios, and based on that, it will estimate the intrinsic value. Finally, the intrinsic value of the company, it is estimated around 3,000, as we can see here. And since this is a Monte Carlo simulation, it has a minimum value and a maximum value. So the current price is 2,386, which is below than the minimum value estimated by the Monte Carlo simulation. In terms of price and based on the results and the ratios of the company, this is an estimation of the price over the next 10 years. And finally, if we look at the price evolution over the last 5 years, as we can see here, the current price is in the middle between the average price, weighted average price of the last 3 years and the weighted average price of the last 1 year. So thank you very much for your time. Hope you have enjoyed this small video, and leave your comments below. Thank you very much. Bye.